Okay, I want to bring in Jerry Parker. We've got the CEO of Chesapeake Capital joining us to talk about some of the existing trends we're seeing in the marketplace. Jerry, you've been on quite a bit recently. We've talked about the indices, the S&Ps, the NASDAQ. We're really the focus of that conversation, but I feel like we're going to have to start to shift gears over the next coming weeks if this continues and small caps and the Russell steal the show.
Well, thank goodness that my diversification into all the different caps is finally paying off. I think that's one of the good lessons for traders, is to embrace the diversification as much as you're willing to embrace sort of a relative strength and trying to always switch back and forth between the stocks and the markets that seem to be the strongest. Because as soon as you do that, you could see a change in leadership. So I like to embrace the diversification and sit with some of the things that are lagging, and maybe they will catch up and help out.
You know, I like that. And you always talk about diversification, right? And I think it's important to remind traders, basically, as initially painted out towards me, is if you're only trading the S&Ps, the E-mini contract, you're going to force trades that you shouldn't be in. You're going to find situations that look like, you should be participating. You're not going to be able to be as patient as you are and precise or detailed in terms of finding those really good opportunities that you would find if you had a basket, for example, a handful or even more products that you participate in, Jerry.
That's right. Especially if you're trend following, you could be over positioned, because the S&P is long.
Or forced to be on the sidelines.
Exactly. So beneath that S&P hood, you're going to find some stocks in an uptrend, some in a downtrend, and you can put on your longs and shorts if you want, and have a more balanced approach to the market and really see what's happening in the market. Because we did have some major leadership and lack of breadth there for quite a while in seeing the smaller stocks not participating. But now you get a better sense of what's really going on in the market rather than just paying attention to the indices all the time.
Yeah, I like that. Again, you could get overpositioned, right? I tend to think of it as, okay, you're more forced to be on the sidelines because there's really not a good apparent trend oftentimes, and so you sort of force one. But sticking with that kind of overposition, I feel like that could happen really easily right now. I kind of feel like we're sort of in an environment where unintentionally you sort of establish or find yourself in a bit of a Texas hedge, right? If you're long the indices, long some of these individual names, the Nvidias, the Eli Lillys that we've talked about in the past, when the market turns ultimately, again, it could be a bit painful.
Oh, of course. And then, that's why I like to have a few shorts on. There's plenty of stocks that you can short on some of the large caps. They're sort of been in downtrends, and some are making new breakouts to the downside. And pretty soon it's going to be time to, from a trend following perspective, to probably go long the bonds, and not already. It looks like those trends may be turning around a bit.
Well, then we'll keep an eye on that. We'll continue to track those a little more closely than we have been. For the most part, we kind of just recently have been looking at yields and maybe should be focused a bit more on the treasuries. I'll pull the chart in a second. But, Jerry, I feel like asking you this question is kind of like asking the colonel, right, to give away his secrets, right, the special recipe ultimately. But what is it that you look for in terms of when we see this trend starting to turn? What should we tell our viewers to stay on top of, to keep on the radar, to sort of get a little bit of a cue, a bit of an indication that things are starting to lose momentum, which, again, at this point, they don't seem to have by any means, but we know at some point they will.
Oh, no, at this point, we want to be longer term and not be influenced by every small up and down in the markets. I like a longer term approach and a very old fashioned approach that everyone probably knows about, which is the golden cross, the 50-day moving average crossing over the 200-day moving average. It's just always going to get you on the right side of the trends. Sometimes you're going to take a small loss, and sometimes you're going to get back profits. But if you want to participate in the meaningful trends that we see over time, especially the stocks that we're seeing now, this 50 by 200 moving average crossover, the golden cross, it works really, really well. Unfortunately, it makes you stay in there a long time and accept some volatility and maybe some drawdown.
Well, wait, unfortunately, it makes you stay in there a long time, some drawdown, some volatility, but through that process, you get to, again, benefit and you get the reward of that longer term trend, as you mentioned. So it's not all downside. There's going to be steps back, but the two forward is what's really rewarding, I feel like, in trading, right? One back, two forward. I mean, that's progress.
That's right. And it's the psychological part. We're always at war with ourselves.
Yeah.
We kind of know probably in general the right thing to do to maximize our terminal wealth. but then that goes against our human nature of sitting with big winners and allowing the market to fluctuate some.
Yeah, we know what to do, but oftentimes, in fact, we do the exact opposite, right? I used to remind myself as a child, my mom used to say, hey, go do something, right? She was always so busy with 5 kids running around. That's how I approach trading. I want to grab the mouse and just start clicking or changing a stop or, adjusting a parameter, but ultimately just stand there, do nothing stupid is kind of the way that I used to remind myself. But sticking with that longer term trend also kind of just a last thought here, Jerry, that sort of helps you sort of avoid that, right? Over trading, over managing, micromanaging trades, and just kind of plan the trade and trade the plan.
Oh, exactly. And if you want to be a little shorter term or a little bit longer term, really the key in successful investing, from my point of view, is a systematic, rules-based approach. So let's adopt a few rules like this that go with the trend and take small losses and diversify broadly. And it doesn't take a really quant or back test to figure out what it's going to take, the time frames and the moving average crossovers that it would take to sort of participate in these long-term trends. But rules, systematic approach, that's the key.
I would add to that thought a systematic rule-based approach, one that has positive expectancy as well, right? You can't just throw money into the wind. Jerry, appreciate you joining us here. Really a great conversation this Tuesday morning from someone who's been there, done that. Jerry Parker, CEO of Chesapeake Capital.